Today's hearing is entitled "The Current Mortgage Market Undermining Housing Affordability with Politics." We will receive testimony from experts in the housing industry to discuss recent actions taken by the Federal Housing Finance Agency. Housing affordability is crucial to giving Americans the opportunity to build wealth through home ownership. Home ownership, in turn, paves the way for success in many other aspects of life. In essence, housing affordability is a cornerstone for pursuing the American dream. The importance of maintaining a fair and undistorted mortgage market cannot be understated. Currently, residential consumer mortgage debt accounts for approximately $12 trillion, which is spread across over 80 million mortgages. Of this $12 trillion, Fannie Mae and Freddie Mac, collectively known as the enterprises, guarantee approximately 70% of the market. The FHFA, the entity charged with supervising the enterprises and acting as their conservator, must be immune to political agendas, regardless of how much any administration pressures this agency. The FHFA, therefore, retains an exceptional degree of authority to impose rules that shape the entire mortgage market. It is this authority that brings us here today. In light of recent proposals to change the loan level pricing adjustments set forth by FHFA to be implemented by the enterprises. So when created in 2008, loan level price adjustments, LLPAs, were also known as guarantee fees. They were put in place to allow the enterprises to charge for the credit risk associated with mortgages that they were guaranteeing. These fees are designed to cover the risk of standing behind the mortgages and to protect the solvency of the enterprises. The recent changes to these fees that went into effect on May 1st, however, are alarming because they disproportionately increase fees for borrowers who have higher credit scores. Any way you slice it, prices will go up for consumers who have credit scores above 680, and even for some of those with down payments of more than 30% of the loan. So in other words, this pricing scheme would shift most of the cost burden to more creditworthy borrowers. The FHFA contends that the loan level price changes are attributed to higher capital standards that need to be imposed on the enterprises. While this could justify some change in LLPAs, the change we saw imposed on May 1st clearly targeted new home buyers with average credit scores and above. And we've also heard from that the FHFA contends that interpreting the new LLPA chart must be coupled with mortgage insurance coverage, so as to paint a full picture for consumers. And while those with lower credit scores and low down payments are certainly likely to pay more on mortgage insurance given the risk they present, this is an entirely different credit product whose fees cover the cost of the insurance itself and go to an entirely separate entity. Mortgage insurance payments do not help the enterprises to build capital or to actually protect the taxpayers from risk. Make no mistake, these changes to the LLPAs ultimately hurt housing affordability for the majority of home buyers. Even if it's a relatively small cost for some, it's inappropriate to place the burden on Americans simply because there is a misguided notion that they can, quote, afford it, especially with the high cost of inflation that's plaguing our economy. Now, to be fair, we've already seen the FHFA reverse course on some components of the LLPA changes. And while also issuing a request for input on its method for determining LLPAs. So these are positive but small steps in the right direction, and while we welcome these changes, they are insufficient. This committee will ensure that we have appropriate risk-based pricing and an efficient mortgage market. And so the witnesses here today will be critical to providing insight into how we can get that done. So I thank our witnesses for their testimony today, and I look forward to the conversation.